Hey everyone, it's Gerald here. In this video, we're going to go over what is an undervalued stock, its relevance, how to apply it, and so forth. So what is an undervalued stock? An undervalued stock is a stock that is trading at a price lower than its intrinsic value or worth. In other words, the stock's market price is considered to be lower than what it should be based on fundamental analysis of the company's financial health, earnings potential, growth prospects, and other relevant factors. Investors often see undervalued stocks as potential bargains because they believe the market has not accurately reflected the true value of the company, presenting an opportunity for future price appreciation. Understand the difference between price and value. Price is what you pay, value is what you get. The stock market is here to serve you. The key here is to figure out what something is worth. So you have to weigh price and value. Value is the present value of the cash you can take out of it over its life. A stock isn't an interest in a business. It's like owning a piece of the company. With a stock, you have to make predictions about the business. How much are they going to sell this year, next year, the year after that? What are the costs? How much money do they need to reinvest into the business to keep it going? Find undervalued businesses that you have a high confidence and certainty in. There's also investing versus speculation. The stock market in the short term is a voting machine. It represents speculative interest, supply and demand of people of the short term. The long term is a weighing machine. It's a more accurate and will tell you what something is really worth. If you can really figure out what something is worth, you can take advantage of that in the stock market. That is why the stock market is here to serve you. Speculation is like short-term trading crypto. Maybe in the long term, there's intrinsic value. Most people that go into that type of trading, they just know it's going up. They don't really know exactly what it's worth. Investing is doing your homework, digging down and understanding the business, understanding the competitive dynamics of an industry, understanding what management is going to do, understanding what price you're going to pay. Investing is about building a model of what this business is going to produce over its lifetime. Why do you need to invest into undervalued stocks? There are a few key reasons that I want you guys to invest into undervalued stocks. Those key reasons are there's a bigger upside, which means more money that you can make. There's less risk involved. The lower something is that has fallen, the less chance it continues its descent. Contrarian approach. There is a reason why many people are not successful in this market. If you approach this market in a contrarian approach, you're able to reap the benefits of investing. Part 1. Factors to look at. Where can you find reliable information from? Most of the information you can find online, but to fast track most of the research process, I highly recommend that you guys use Finviz. It's up to you if you want to upgrade your account. Here's the link, just finviz.com. Before we start, and here's the rule of thumb, I want to look for non-disruptable businesses, or as much as it can be. For example, if the stock market were to shut down for a decade, you know that this company would still be here and still be profitable. The key is to buy at a price that represents a big discount to its value. This allows you to have a margin of safety. Buy at a price that even if you're wrong, you paid at a deep enough discount that you'll still be okay and even be profitable. A big part of investing is not losing money. Avoid losing money and have a lot of big hits. First metric I look into is revenue. One of the first things that we want to look at is a company's revenue. This is the income generated before deducting any expenses, taxes, or the cost with running the business. This is typically considered the top line of the income statement and is the starting point for several financial metrics. A good rule of thumb here is to see if the revenue has been trending in the upwards direction for the past few years. Profit margin. Profit margin measures a company's profitability expressed as a percentage, accounting for all costs, expenses, and taxes. This shows how efficiently a company operates. Think about it like this. Would you want to invest in a company that is negative, or you want a company that is making money every month, every year? Obviously, you want the company that makes money. PE ratio, price to earnings ratio. This measures the current share price into its earnings. The lower the PE, the better. Why is that? A PE ratio of 5, it would theoretically take you 5 years to make back your initial investment with the company's current ongoing profits. If you had a PE ratio of 100, it would take you theoretically 100 years. Of course, you don't want to wait 100 years. You want a PE ratio that is on the lower end. And what you want to do is you want to compare that to the company's historical averages. What does it normally average in a 3-year, 5-year time span? Next is free cash flow. This is basically how much does it cost to pretty much operate the company and how much of that money is left over. It's a reliable measurement of how efficient the company is at producing cash from its regular business activity, and it's an early indication of the cash flow shortages, which is essentially debt, and whether or not the company could end up going broke. You don't want a company that has poor free cash flow and you end up buying into a company that ends up going bankrupt. You want companies that have simple, predictable, free cash flow, generative, dominant business. A business that Warren Buffett would describe as having a moat around it. You need to know how much cash a company is going to generate over its lifespan. Because if we can't predict that cash flow, we don't know the worth. We can't invest into a company like that. So figure out how good the business is, how predictable will this cash flow be. Debt. Lower levels of debt is considered less risky. Seems fairly intuitive. If a stock is undervalued, it's crucial to ensure it's not due to excessive debt. Think about the current interest rates posed by the federal government. They've been increasing the interest rates. That has left a lot of companies, a lot of growth companies that have a massive amount of debt to be at risk of even bankruptcy and ultimately a decrease in its share price. Relative Strength Index, the RSI. The RSI measures the speed and change of a price of a stock and can tell you if the stock is currently oversold or whether it's undervalued. An RSI below 30 is considered oversold and potentially undervalued. An RSI above 70 is considered overbought. I would not touch any of these stocks. We're not going to be chasing companies. We're going to be finding companies that are oversold. And the macroeconomic conditions. Macroeconomics refers to the market as a whole. Some of the questions I want you guys to ask are, what are the current financial policies being implemented by the federal government? Is the government in a period of quantitative easing where they're pumping money, inflating the economy into the stock market? Or are they in a period of quantitative tightening where they're reducing their balance sheet, taking the money away from the stock market, ultimately reducing the share prices of the stocks? You can use AI to fast track a lot of your questions when it comes to macroeconomics. I personally like to use perplexity.ai. We'll be looking into things like inflation, a key metric that's been going on in the world. It also goes along with the interest rates. You also want to look into employment rates and unemployment rates to see overall how is the economy doing, what is the consumer confidence, and so forth. Other key factors to look at. Remember, so these are the 8 pillars that I want you guys to look at. Number 1, it needs to be a simple and predictable business. Number 2, free cash flow generative. Number 3, a dominant market position, a moat. Number 4, large barriers to entry, less competition, less incoming competition. Number 5, high return on capital. You want a company that is using their capital appropriately and able to generate massive amounts of profit. Number 6, limited exposure to non-controllable extrinsic risks. What do I mean by this? I'm talking about companies like your commodities or oil and gas, where they're subject to a lot of government subsidiaries and a lot of government interference that can ultimately impact the stock price. Number 7, a strong balance sheet where outside capital is not necessary. They don't need other funding or whatever it is to pretty much operate their company. Number 8, excellent management and good governance. You want a management that knows what they're doing. A way to really gauge that in a objective manner is to look at our return on assets, return on invested capital, and so forth. Putting this into action. When evaluating companies, you want to compare a stock with its competitors or companies in the same industry. So for example, Alibaba is considered the Amazon of China, right? So I'm going to compare these two right here. Amazon here with a market cap of 1.51 trillion, Alibaba market cap of 1.78 billion, Amazon with a revenue of 54 billion, Alibaba with 129 billion. Now we're looking to their profit margins. Amazon with 3.5%, Alibaba with a profit margin of 14.5%. You see a free cash flow of 16 billion with Amazon, a free cash flow of 30 billion with Alibaba. So what do we get from this information? Alibaba's revenue is about 4.3 times more than Alibaba, but Alibaba's market cap is 8.5 times less than Amazon. From a fundamental perspective, you can see there's a huge discrepancy between what Alibaba is trading at versus what Amazon's trading at. So let's take a look into more of what I delved into previously. Macroeconomics. China right now is printing billions of dollars into the economy. They're also instituting share buybacks. Stocks trade based off supply and demand. When a company issues share buybacks, it reduces the number of shares from its circulation, thus driving up the stock price. Overall, in 2014, Alibaba had a revenue of $12.3 billion in a year. In 2023, Alibaba has a revenue of $126 billion per year, a 10x increase on the revenue, but the same share price now. You can see here that Alibaba is trading at, objectively, oversold levels. Part 2, investing into undervalued stocks. So what undervalued stocks should I select? When it comes to selecting stocks, I like to stay inside the criteria of stocks that are in the S&P 500. These are stocks like your Boeings, your Amazons, Walmart, PayPal, and so forth. The reason I select these stocks is because of their safety and their performance. Time and time again, these stocks have been proven to grow and they're safe. They're companies that you'll see for a while, if not for a lifetime, right? So I'm talking about your Apples, your Nvidias, your Netflixes, your Amazons, and so forth. You want companies with moats, huge moats. Look at companies with huge moats or presence in the world that we live in today. You want companies that are of the future, that you'd be surprised if they're not around in the next 5 to 10 years. Let's think about some names, right? Like Disney, McDonald's, Boeing, PayPal, Amazon, and so forth. Creating your watch list. If you're a beginner and you're just first starting out, I recommend that you stick with a couple of stocks, 1 to 2 stocks that you can keep track of. If you have dozens of stocks that you're looking at, there's really no way that you can actually really delve into a lot of these stocks in a deeper manner. So have those 1 to 2 stocks that you can keep track of inside of your watch list. Even when it comes to coaching my private students, I always tell them, stick to 1 to 2 stocks at a time. These stocks can be used over and over again, sniping up 3 to 5% gainers along the way and putting into action. So select your stocks, go into the S&P 500 list, select 5 stocks that you know, and maybe even some of the products that you use. So step 1, select your stocks. Go into the S&P 500 list and select 5 stocks that you know about, or maybe you have even used as a consumer. So for example, I'm going to select Boeing, Amazon, McDonald's, PayPal, and Tesla. I'm not going to be investing into all these stocks. I'm going to select this stock that has the best fundamental stats, the one that has a huge selling of recent. I'll then research my companies. I have a worksheet for this so you can literally copy and use for yourself. Everything I follow has to fit into my criteria. So if everything checks out within my screening process, I will heavily consider investing into the stock. Step 3. Creating your watch list. After you've done your research and found your winner when it comes to the most undervalued stock, add it to your watch list. This allows you to put it at the top of your list, and now you're ready to invest. Like I said, I recommend sticking to 1 to 2 stocks in the beginning first until you get the hang of this strategy. And step number 4, you want to look for huge dips. From there, find stocks that had that significant drop. You want those drops to be because of reasons that are fixable. Usually, market overreacts to certain news. For example, Boeing, with its recent plane door incident, caused a massive sell-off in the company, has dropped over 20-30%. It's a huge company that is widely used, widely known, has a huge moat that had a massive overreaction to the downside. This gives us opportunity. And part 4 are the common questions that I get. How do I invest if I don't have enough time? I'm a firm believer if you want something to happen, you have to make it a priority. But I also know that if you're working a full-time job, you simply don't have a lot of time to work with. The beauty of this strategy is we don't need to constantly look at the news and your portfolio. Since we aren't doing any options trading or intensively scalping the market, it's not necessary that it requires a lot of time. Some of my best students only spend 3 to 5 hours a week. What if I lose money? I'm not going to sit here and say that investing with this strategy is going to be risk-free. If anyone says that, they're lying to you. What I can say, though, is if you buy at a huge discount, you'll have a margin of safety. You paid at a deep enough discount that you'll still be okay. And you can always better your average by buying more at the lower values and waiting for that huge upside. A big part of investing, like I said, is not losing money. It's about making money and compounding the money over and over again. Can I just invest later? Yes, you can. But the power of investing now is the ability to compound your wealth. Remember, there is opportunity everywhere in the market. The power of compounding means that the earlier you start investing, the more time your money has to grow. The stock market is at an all-time high. Should I wait when it pulls back? Remember, like I said, there's opportunity everywhere. History has shown that the stock market tends to trend upward over the long term, and there's always new opportunities for growth and investment. All right, guys. You guys now have the tools and the knowledge to find and evaluate undervalued stocks. Hope you guys enjoy and go make some money. Talk soon. If you guys like the content, I'd appreciate you guys like, comment, and subscribe. It really helps a lot. Take care.